Okay, good afternoon, everyone. I'll call this meeting to order of the Post-Secondary Education Financing Working Group, Tuesday, November 9th, 2021. Welcome. We are holding this meeting by, I guess what you would call a hybrid format today. We are in person here at the Legislative Office Building in Hartford, which is exciting for some of us because it is the first time in quite a long time that we have been able to be here conducting meetings. And at the same time, we're going to have a majority of our folks participating by Zoom. So hopefully everyone is able to hear and see each other. And I think there's only a handful of committees or task force that have attempted this so far. So hopefully it goes smoothly. So with that, I would, I think it'd be good to start by having everyone just briefly identify themselves again. We do have a new member or two actually to the working group. So I think if we could start, I'll first ask my co-chair, Jeanette Weldon from CHESLA, to say hello.
Hi, thank you, Representative Doucette. Jeanette Weldon, I am the Executive Director of CHESLA. And thank you all for joining this meeting.
Okay. And you have your staff with you today participating?
Yes, I'd like to introduce Josh Herlock. Josh is CHESLA's Assistant Director. Josh, you want to say a few words?
Yeah, hello everyone. Happy to be a part of the group.
And then also a staff member is Dan Junji, who is our legislative liaison.
Hi, thank you for having me.
Okay, thank you. Julie.
Good afternoon, everyone. It's a pleasure to be here. Thank you for inviting us to participate. I'm Julie Savino, and I'm Executive Director of Student Financial Assistance at Sacred Heart University.
Thank you, Julie. Just working counterclockwise here. Matt Smith. Matt, you're muted.
I think I would figure that out by now. Hi, everyone. My name is Matt Smith. I work for the Connecticut Department of Banking. I'm the Director for Government Relations and Consumer Affairs. Happy to be here. Good to see everybody.
Very good. Next, I see Krister.
Hello. Thank you for having me, everyone. I'm excited to share space with you all. My name is Krister Estrada Perez. I am here on behalf of Connecticut Borrowers. I belong to the Borrowers Collective as well as the Student Loan Fund, which is an organizing group that really rallies around student loan support, student loan debt cancellation. And so we're here in support and to bring the voice of student borrowers from Connecticut. Thank you for having me and excited to share space.
Thank you, Krister. Next, I see our newest member, Winston. Winston, if you'd like to say hello and give a little bit of an introduction.
Yep, thank you so much, Representative. So hi, folks. My name is Winston Berkman-Breen. I'm the Policy Counsel at the Student Borrower Protection Center. I'm taking the reins from my colleague, Kat Welbeck, who was here last time as we had some internal transitions in leadership, but I'll be with us going forward. Very excited to be here. We're a national advocacy group that works on behalf of student loan borrowers and their families everywhere, including Connecticut. And prior to joining Student Borrower Protection Center, I was the student loan ombudsperson for the state of New York, based in the state's financial regulator, the Department of Financial Services, where I was also the advocacy director and a legal aid attorney prior to all of that. So hoping to bring that to bear and join the conversation today.
Thank you so much. And just by way of background for the benefit of the rest of the working group, originally Seth Frotman, who was the executive director of the Student Borrower Protection Center, is that correct?
That's correct. The founding executive director. That's right.
Was the first appointment to this. Seth, and Winston, maybe you could fill us in more on this, I think got the call up or back rather to CFPB or in some capacity in the Biden administration. Is that correct?
That's right. I think we've been asked to let them issue their press release first. So it's a little bit mum's the word until then, but if you Google, I think you'll see that's the case, and we should have an announcement about the particulars coming out soon. So we're very, bittersweet to have lost him from our organization, and that explains a bit about the musical chairs as we staff this meeting, but excited to see the work that he'll go on to do. So thank you for that. Yeah.
Yeah, no, great. Very, very happy for Seth. And Seth is pretty well known in Connecticut, has collaborated with us here on a number of different initiatives and pieces of legislation over the years. So we're very happy for him and his successes and that of your organization. Thank you, Winston. Fred. Fred Good, are you there?
Yep. Hey, sorry about that. I was double muted with my phone and the Zoom meeting here. So Fred Good, Citizens Bank, student loan group. Pleasure to be here representing the banking industry. Thank you.
Thank you, Fred. And I see Bruce Adams has joined as well, who representing the credit unions, who was not with us.
I have.
Bruce.
Yes, hello. And I'm sorry that I'm on the move, but I got called to Albany, so I'm on the road.
It's quite all right. Okay. All right. So with that, also want to introduce some of our, and then I'm sorry. Because I don't see you on the screen, there's one other member here with us who is not logged into Zoom, and I will let Representative Delnicki introduce himself.
Good afternoon, Chair. It's delightful to be meeting in a committee room and having a semblance of normalcy here. And I look forward to more meetings in committee rooms and actually some of the folks that we have on Zoom actually coming in and testifying and discussing the issues before us. So I look forward to the meeting here today. I'm glad to see we're in the committee room and can't wait to get started.
Very good. Thank you, Representative Delnicki, and my apologies again. I was looking at the Zoom here, and that's, I guess, one of the things that we have to juggle with the hybrid format. And I did want to conclude just by introducing some of our legislative staff here. We have Azani Imatevsky from the House Democrats Policy Office, and we have Dawn Marzik, who is the clerk of the Banking Committee and also the clerk of this working group. And I believe I also saw Audrey Rosignol, who's also on our policy staff as well. So with that, let's get into it. As you know, at our last meeting, we sort of kicked things off by discussing the goals of the working group. And in order to, start what I hope is a robust discussion about these issues, we sort of put the solicitation call out for members to contribute data, as I think the folks that we have assembled collectively have a great deal of knowledge, experience in the industry, and we, the policymakers, speaking on behalf of myself and the other legislators, look forward to hearing that information and your contributions. So as you know, we put the call out, and there was a good deal of information that we've received over the last few days. For those who have not seen it yet, there is a Google Drive that's going to contain and be the repository for all the submissions made to the working group. And I believe most of that information is also going to be available to the public on our webpage, our CGA webpage. So I thought we would start by going through some of that, and I'm going to allow the folks who submitted that information just to maybe briefly summarize it and call out some of the highlights. I think the best place to start would be with Jeanette Weldon and her staff from Chesla. Jeanette.
Yes, thanks very much. And Thank you also to all the members of the working group who submitted information. I think we have some interesting data that's been provided, some of it at a national level and some on a state level, which can provide some context. And then also some portfolio specific data. And so obviously, there's lots of data out there, and we certainly look forward to continuing to receive information and having more information available to review at future meetings. But just to start with CHESLA information. So CHESLA did take a look, and this is portfolio specific data. So it's kind of at somewhat of a micro level, but we looked at a couple of things just to compare our approved loans compared to our loans that were denied approval. And Dawn, were you going to put up slides, or otherwise we can share slides?
Whoever has it ready first.
Okay, then I'll ask Josh Hurlock, our Assistant Director, to share his screen, and he's going to walk through the slides that we submitted.
Yeah, sorry, I thought they were going to be shown. Just give me a second.
Josh, I made you the co-host, so it should work now.
Okay, yeah, just give me a minute.
I'll just add, we looked at a couple of different, we looked at two different breakouts of information. One is distribution of loans or applications by town, and the other is distribution of applications by income level. And so those are the points of comparison in terms of approved versus denied. Were you able to get that, Josh?
Yeah, I believe so.
Okay, great.
So, okay, thank you, Jeanette. Can everyone see my screen? Okay, so the first point I wanted to mention is the CHESLA information being provided here is from September 2019. This is because we switched our loan originators around that time. So this is the information we have available. So as Jeanette mentioned, the initial information we have here is by Connecticut towns. We show the top 14 towns for approved loans, representing a percentage share of 1.5% or higher since that September 2019 date. We then show the subsequent towns for denied loans, also representing a 1.5% share or higher. I think some key takeaways here are that, the disbursements by town are pretty across the board, across the state, not real region specific. We also have some certain towns here, such as Milford, West Hartford, and Middletown, who you will see on the approved loan list and also the denied loan. So again, pretty disbursements pretty much across the state. Are there any questions on that, or Jeanette, do you have anything to add?
Well, I just wanted to highlight the reason that we know, they're widespread across the state is because when you look at the other category, so it's for approved loans, it's 71.5%, and for denied loans, it's 60%. So, I think it's showing that there's no single town that is being heavily relied upon for loan volume. So I think that's significant.
Right, and going off of that, even the highest percentage for approved or denied loans is pretty small at 4% and 3% respectively. Moving to our next piece of data, we have approved and denied loans by income tier. And again, it's pretty spread across the board by income tier, whether it's approved or denied loans.
And one thing I want to point out is that the Chesla's criteria for income level is a minimum adjusted gross income of $20,000. So it's a pretty low level of income that, it's a low threshold. But when you look at the approved and denied loans, there's actually a fair amount of overlap in similar or the same income levels. So, we have 10.5% in the 20 to 50,000 approved, and another 40 up to 100,000. So combined, more than half of the approved loans are actually going to people making $100,000 or less. Similarly, it's not dramatically different from the trend that you see on the denied side. And I think, there are, so just like there are some high earners that have been denied, and there are some, as shown by the numbers, some lower income tier levels that have been approved.
And just to what Jeanette stated, on a Chesla loan, the student's always the borrower. So typically, these students would have a co-borrower to secure the underwriting of the loan.
So that is the Chesla specific data that we wanted to share. If there are any other comments or questions, happy to
Josh,
respond.
I did have a couple of questions on that, and Josh, you had just touched on this. Just for clarification, when we're talking about the income, we're talking about the actual borrower's income, but also including co-borrowers or family contribution. How exactly does that break out? And I imagine, obviously, the answer is specific to each borrower in each application, but generally speaking, when we're looking at this data, we're looking at borrower income, we're looking at family income, we're looking at both.
So this would be application income. Typically, this would be off of the cosigner, but we also do have, you have adults that go back to school and may be able to secure the loan on their own. So that would be reflected here as well. So a combination of the two, but 97% of our loans have a cosigner, and that's typically the only income on the application because many college students are not working.
Okay.
I have, oh, sorry, go ahead.
Oh, I'm sorry. And then, yeah, just one more question is about refinance loans. What percentage of your overall applications are for refinance loans as opposed to direct loans to student
Yeah, so just to clarify here, this is specific to our in-school program. So students looking for funding while they're in school. We provided this because of our principal balance of loans outstanding. About 96% is for those in-school loans. The refinance loans are a very small portion of our portfolio.
Okay. I'm sorry. I think is that Krister who had another question?
Yeah, I guess I have two questions. The first question is about the Connecticut Town Bank data. I don't think it's just because it has the other category. What's the story that you found? Because I see some of to your point, the towns repeated in both ends, but what I don't see are Hartford, New Haven, Waterbury, those critical areas in the approved side, at least in a substantial amount to be, with Glastonbury and Milford. So what's the story of like those areas in your findings from the data?
Jeanette, do you have any?
Well, I think those are all falling below 1.5% in terms of, we're displaying what's 1.5% or higher. So those are at any towns not displayed here are below 1.5%, and they are lumped into other. I mean, to the extent that there are some the income levels shown on the next page translate into some of these towns that perhaps have majority of population with certain income levels. That can be part of what's reflected. But as we saw when we looked at the income tier data, it is pretty well distributed. We certainly do, when we're doing our outreach to students, we reach out to students throughout the state. We have, in the past couple of years, we instituted a program of going into schools, and Josh can speak to this further. Do you want to talk about the outreach program, Josh?
Yeah, so my staff has put together a financial aid basics presentation. We conduct outreach to all high schools throughout the state, offering to go into those schools to do that presentation for the students in the classroom. We're also available for financial aid nights across the state. So we reach out to all the high schools, and then we'll conduct those presentations for those high schools that are interested.
And I guess my second question then is about the income tier data space. Are there any other, because we talked a little bit about what other services could be provided. What happens to, I see here the denial of 283 loans denied of $0 to $19,000, leaving out a certain percentage of the population. Are there other benefits that folks that fall in that category have access to after the denial, or is it just?
So we do offer an income, a need-based scholarship program, and that was created because we wanted to acknowledge the fact that loans are not for everyone, and it's not going to be a helpful tool for all students. It actually, for some students, might be a detrimental tool. And so we do offer a need-based scholarship program that's been in existence, Josh, 5 years or?
Yeah, at least 5 years, and actually more than 5 years, and we've dispersed almost $10 million through that scholarship program, and we tie that need-based component to the expected family contribution from the FAFSA, And basically Pell Grant eligible students would be eligible for our scholarship program.
That was helpful.
Thank you, Krister. I think that's a good point on the town, going back to the town data. That was one thing that jumped out at me, is that we do see our largest cities here on the ranking high on the denied loans list, but not registering on the approved loans list. So they're less than 1.5%. Talking of Stanford, Hartford, Bridgeport, Waterbury, I see on here. But those are ranked highly on the denied loans. And you know, it's not a wide disparity by percentage in the number of loans. You know, we're talking 48 in Stanford as opposed to 44 in Milford, the next one 43 in Hartford. But I did notice that, and I do think it's significant that we see our major cities ranking higher on that denied loans list as opposed to approved loans, and something.
Yeah. So this is Fred Good with Citizens here. I mean, to that extent, right, would there be a way to see this data represented as an approval rate by town? You know, so total approved divided by total applications, right? To essentially, you kind of control for the overall level of volume that you'd see.
Yeah, no, that would be interesting to look at.
Yeah. No, I mean, sure, that's another way to slice the data. I mean, I think, you know, I think some of that can be gleaned from looking at it in this format, but sure, that's another way to sort it.
And then I just wanted to add something regarding the towns. You know, typically, you know, Waterbury, Hartford, New Haven, those are very popular towns for the aforementioned scholarship program.
Nikki.
Thank you, Chairman. Follow-up question on the comment that I heard about 97% having a co-signer. On the denial group, what is typically the reasoning for the denial? Is that a function of not having a co-signer or just income, or what?
You know, so it could be, we don't use FICO score. However, we are looking for a fairly clean credit report. So there could be red flags off of that credit report. Or also it could be you know, not enough income on the application. Or we take a look at the debt to income ratio, because that's an industry-wide tool that is used to determine the kind of underwriting approval aspect for the loan. It gives a lender a reasonable assurance that the loan will be paid back and will not default.
How often do you see co-signers on the denial list in that group?
I don't have that available right now. I would have to look deeper into that.
But I do think and correct me if I'm wrong, Josh, the majority of our loan applications are made with a co-borrower or co-signer. So I believe that the majority of the denials are still based on, because the process is, if someone applied on their own and it was clear that they would need to have a co-signer, then they're informed of that. Is that correct, Josh?
Yeah, that's a good point. On the initial page of the application, it's made clear that there needs to be at least $20,000 of income on the application. So if you, the student, do not meet this income threshold, then you will need a co-signer for the application. So, you know, based off of that, I would say most of these denied loans were applied with a co-signer that may have had credit issues, et cetera.
So they know that up front then when they're filling the application out.
Yes,
All right, that's good to know. It might be worthwhile in actually knowing some of the reasoning on the denials themselves, whether they lacked the income in the cosigner or had a number of the other issues that you had mentioned when it came to making the decision on whether a loan would be made or not made, just from an analytical perspective.
Okay.
Thanks,
you,
Rep.
Chairman.
Delnicki. I see some hands up on the Zoom. Going to go to Matt Smith next. Matt?
Thanks, Chairman. Hi, everyone. So dovetailing off of what's been said earlier, when you're looking at the data, and again, just looking at this now without a lot of thought, I just want to preface that. The $20,000 to $50,000 range, those denials are in excess of a 2-to-1 compared to those that are approved. And then once you get to the $100,000 category of income, it's completely reversed. They're approved at a 2-to-1 over a denial. Now, if you glean from that missing from the approved list are the major cities where we're going to see a higher concentration of people with less income. I think the story that this paints is that a lot of the lending that's going on isn't happening in the cities. And then that's further exacerbated when you look at a per capita student. You know, the cities generally have larger populations, and so you're lending less to a bigger pool of people and you're lending more to a smaller pool of people. I think that's interesting. I think that's something that the data is sort of speaking to me. That's what I'm seeing.
well, yeah, I guess, one interesting thing with regard to the town by town is, Stamford, which is on the denied list. That's a city. I haven't studied the demographics of Stamford, but my understanding is I think there's some high wealth as well as some, lower income areas. So it seems, so I guess all of that is just to say, I think the fact that Stamford is not showing up on the approved list sort of speaks to it's not necessarily, it's not like we're looking at towns and none of this is being driven by which town has the most money. It's being driven by loan applications and in terms of our outreach to all high schools across the state. I mean, we have, I think, a robust outreach effort. And I think one of the points that I've made at the prior meeting is that, loans are not a tool for all students. We are not, out there advocating to all students, no matter what, make sure you take out a loan to go to school. And we are trying to provide alternate tools besides just loans for students where a loan may not make the most financial sense for them.
Yeah, I agree. I and certainly, I don't have enough to speak to that. But I think when you look at the data, it trends with what we see nationally and what we hear of stories of people who, first generation college, people coming from, poorer households and everything. And what we see happen to those people, as they go through the college process, whether or not they finish, whether, how much they have, how much debt they have, afterwards, and whether or not they can pay that off, et cetera. I think this data sort of supports that from the way I'm seeing it.
Right. And I think that speaks to, some of the other things that we're trying to develop with the Alliance District Teacher Loan Subsidy Program, which is the other piece of the legislation that included creation of this working group. So in that program, we are structuring something with SDE that will, and that has state dollars coming into it, that will allow for a broadening of the access to this to a loan product, because with these state dollars, we're able to reduce the interest rate even further and make the debt even more affordable for that group.
Thank you.
That's it.
Going to go to Julie Savino next. I see her hand up on the Zoom.
Yeah, thank you very much. As I've just been listening to the commentary here and just what Jeanette had said much earlier on in the presentation, Krista had said, are there other resources? I think we need to keep in mind this CHESLA loan is an alternative loan. It would take place for many families who felt that they wanted to, not necessarily always because of access, but because of choice, higher education, that they would go. Typically in the aid office, this is going to be the last resort for which the family is going to be looking at their family share. And it will probably exist amongst its greatest competitor is the Federal Plus loan, which has, while it doesn't have as attractive an interest rate as our CHESLA loan does have, it has a much more flexible way of receiving that particular loan. So this isn't the only resource. I think this is a wonderful tool for our Connecticut students and our Connecticut schools because it has so many advantages when students run out of options, but many students have other options that they are pursuing as well. You know, in the course of helping finance their education.
That's a good point. Thank you. Winston.
Thank you. And thank you both to Jeanette and Josh for putting this together. It's really interesting. Picking up on where Matt had actually sort of left off, I guess, could we go back to slide 3? And I'm sure the numbers could be crunched this way, though I don't want to attempt to sort of like live air, do the math for you all in my head. But I just think it could be interesting to see, this appears to be approval and denial rates banded over income, right? So everything each income band is a numerator over the denominator of total approved, total denied. And I think Matt was going this way as well. I think it'd be really interesting to see success rate within an income band. So proportionally our lower income households getting the same outcomes as more well-off households in terms of getting, and I think it's just a matter of sort of flipping this. If there might be like a third category of abandoned, I don't know if there's an abandonment rate as well in addition to approval and denial, but it's probably just as easy as taking the 209 of 20K to 50K and adding it to the 578 as the denominator and doing that. But I think that could be an interesting metric to see how our households of different income bands navigating the application, approval, and denial process as an indicator for potential hurdles, programmatic fixes, outreach fixes across those different income bands. But I think this is great, and thank you again to the whole team for putting this together, though it'd be interesting to see that horizontal cutting rate as well, which Matt also mentioned, I think.
Yes, that is a good point. Thank you. Next, going to go to Fred.
Hi, thank you. So just building off of what a lot of the folks here have said, right? And I think as Julie noted, there's a significant portion of borrowers that may be looking for a plus loan. And I know we've provided some data around, who's getting that. But I think we should note, and I guess, kind of a question back to the CHESLA group is around these denials, right? It sounds like in looking at this, and I kind of applaud you guys as a prudent lender, that you're looking at some type of affordability metric for these customers, right, to make sure that they're going to have a strong ability to repay the loan, after they take it. And Jeanette, I know that you kind of mentioned that a loan's not the right course for many borrowers, and seems like, to your determination, somebody making less than 20,000, fits that. I guess I'm curious as to, what other affordability metrics do you have, and that may be driving some of the denials for borrowers making over 20,000. And again, understanding, I think a good lender is going to drive a good result for them, meaning the loan gets repaid, and a good result for the customer, meaning that they're able to take out a product that is actually suitable for them, and they're likely to be able to repay it. So I guess, I think for me, it seems less relevant as to, how many of these customers in each band are necessarily being approved, but of the ones that are being approved and are, taking that loan, how many of them are having a good outcome with that loan 4 or 5 years later?
So I guess, not sure that I can answer, all of the questions that you put into that commentary, Fred. But one thing that I do think would be helpful, probably on a going forward basis, is to have some comparative data to look at and to assess along with this CHESLA data. So to the extent that there's comparative data for bank loans that are made to Connecticut students, as well as credit union loans that are made to Connecticut students, I certainly think that could help inform some of the commentary. But our $20,000 is not our sole criteria. The other key criteria is the debt to income ratio that Josh mentioned. And we use not to exceed 43% is sort of the benchmark that's consistent with what's an industry standard type of benchmark. And that's just taking all of your sort of, fixed expenses and putting it over your income level. And as far as, when we're, you mentioned that, lenders are looking for a good outcome for themselves versus, what's the outcome for the student. I will say that, CHESLA as the state's affiliated lender, we are a nonprofit entity. So we are not, trying to find ways in terms of what's good for us. We're not defining good for us as, we're making lots of money. So I think that's important to note. Our source of funding, the money that we use to make loans, does not come from the state, and it's actually not a free source of funding to us. We have to issue bonds in the public debt markets in order to get money to make these student loans, and we have to be able to pay those bonds back to the investors that purchase them. And so that's just the structure under which CHESLA operates, and it creates a constraint versus if the state were to just give us money, and from there we had free money with which to make loans. So just wanted to mention that in terms of I think we do take steps to counsel borrowers as appropriate when we see that they are running into some difficulties. We also, another key product of ours is a financial literacy portal that has a great deal of information that can assist students and families with money management. So that's my response at this point in that regard.
Thank you. So I think it might be a good idea to segue a little bit. And Fred, that might have been a good intro. I did want to go around. There were some other submissions of information. And Fred, I know you had provided some information, and I'm not sure it just came in, so I'm not sure if it's been uploaded just yet, but certainly by this afternoon, I would think we would have all the submissions we've received uploaded. But Fred, did you want to talk about, the private lending, at least the bank space? You also sent over some information on, historical pricing and interest rates generally. I wanted to kind of give you the floor for a little bit as we moved on.
If you want me to pull up any of the links that you sent me, I can do that.
Fred, you're muted.
Hi, can you guys hear me here now?
Yep.
Got me? All right. Great. So thank you. And yeah, we can pull them up, or I can just really speak through it. I think there's more research that we're looking to try to do, here on our end, as well as try to figure out, overall industry, participation, around approval rates and underwriting criteria that, other lenders and citizens, more specifically would consider to be proprietary. So looking at, kind of some level of overall industry study. But really, what I pulled together was some overall information around, really access to a loan, right? Which I think, as I understand, the potential legislation and what we're looking to try to do here, right, is it calls for, a point of view to determine, is there ready and available access to loans is kind of one question. And then secondly, is there access to, kind of what's called a low cost loan, number two, right? And so the easiest thing to kind of pull together is less about the private market and more about the federal market, which represents, somewhere between 85 and probably 92% of the overall amount of student loans. And, what we see within that marketplace is for the state of Connecticut in academic year 2019/2020. So, first semester starting in September of 19 and ending in, likely May of 2020. Then approximately $1.1 billion of loans were borrowed from students attending a school in Connecticut. And of that, about 95 million was the Parent Plus loan that we had just talked about. Parent Plus loan, unlike a prudent lender like Chesla, essentially does not have any real underwriting criteria. It doesn't have any level of affordability metrics, to determine whether or not it's a sound product for that borrower to take. So, not providing commentary on whether or not it's good or bad, but mostly that it is, kind of widely available. And then, secondly, from there, if we're of the understanding that, the federal market is between 85 and 92%, right? That would mean the private market is somewhere between 8 and 15. Then you can kind of do the math, and it'd be greater than $10 billion went in private student loans nationally, during that same academic period. Because I think so the second part of the question is, trying to determine, if a loan, how we want to determine as a committee what is actually affordable or low cost, pending the legislation. So kind of let me pause there for a moment just to see if there are questions.
Any questions? So just again, for clarification, you're saying about 85 to 92% are federal loans. The rest would be considered private loans. And we could, of course, have some of the same borrowers within those bands, right? So somebody could maxes out on the federal and then, right.
Yeah, that's correct. I think as Julie noted, right, then, most schools' financial aid offices, as well as most lenders, would advocate that a borrower would maximize the amount of their federal subsidized and unsubsidized loans prior to borrowing, either as a plus loan borrower or as a private or alternative loan borrower, given the availability, rate and other features associated with the subsidized and unsubsidized program. So yeah, to your point, there likely would be a significant level of crossover of borrowers taking both some form of federal loan and private.
Okay. And Fred, you had sent over a spreadsheet here, the loan disbursement. Are these Connecticut borrowers, or is this by institution?
These are borrowers attending a Connecticut school. So, that was kind of the best available data that we were able to pull, at the moment. Presumably you would think that a lot of those would be Connecticut residents, but otherwise borrowers that are attending a school, perhaps an out-of-state borrower coming in.
Okay. So that's something interesting to look at. It gives us the amount for disbursements. But then, and I'm going to segue over to Julie, actually, who I see your hand is up. Julie, I believe you might have also sent us the numbers within Connecticut, and which also includes default rates. Is that right?
Yes, actually, we sent some different information. I just want to follow up with what Fred said. In regard to that alternative loan space, I think the one thing we become concerned about in the financial aid world is when we're guiding our parents and our students to making that alternative for coming up with, that additional money, whether after the students have pretty much maxed out their subsidized and their unsubsidized loans, whether they choose a plus or whether they choose a state loan or an alternative, we're always concerned about some students who do not have very good credit. That typically aligns oftentimes with the lower income families. And then they're exposed to a whole different rate of interest rates. So, that's something we have to continue to watch in any of those loan programs that are not fixed, that those students end up with, and with interest rates that, kind of prevent good payment down the road and put them in some of the situations that I think people are concerned about. So that's just a thought that I have, within that space for lending for some of the students that we've already noted on this call we're particularly concerned about. And yes, we did. And with some of my colleagues, we have provided information on what's called the trends in student aid. It's from the College Board. And I think the College Board has been doing this for decades, since the early 1970s. They've been doing an annual report on trends in student aid and college pricing. It's a very detailed report. It has been uploaded to the website. I don't know whether it's a time to go through it because it is so detailed now, or if it isn't something that we'd want to speak to in another time. There's a number of slides that specifically speak exactly to loan programs that you see. This report also takes into consideration the federal and state loans through the information through the U.S. Department of Education, OKSC see Dawn has pulled this up. This is an excellent report. As you'll see, it starts with information regarding the type of aid. This was actually done, this is the most recent one. It was published in October. It's off of our 2021 academic year for basic information that has already been submitted. And you'll see that it does give you the breakdown of federal grants, loans, your work study programs, tax benefits, state grants, institutional grants, private and employer grants, and also those non-federal loans. So I think this is a good display. It gives you information back from the year 1990, 91, all the way through preliminary information from the year 20 to 21, and the percentage of change. As many people will know, we had, particularly in the loan, and if we move down on a few more slides, Dawn, why don't you move down? This one's average aid per FTE. This is a combination of total aid and non-federal loans. As you can see, there's the loans here. This is for graduate students. There is a breakdown for graduate and undergraduate. I think there was the other chart there. I mean, there's a lot to this report. Here's your undergraduate students, the percentage of total funds against the academic year that has been borrowed. You'll see that the grants, unfortunately, we've seen some decline, but we have seen a rather nice increase in grant funding, both through federal governments. The states have been pretty static, pretty flat over time, but and institutions themselves have increased dollars. And as a result, you've seen that loans have actually had a decline since around the year. They peaked up in around 2004, 2005, and then 2005, 2006, and now we've started to see a steady decline. I think people are starting to borrow more reasonably, only borrowing what you need. I think that's the message that we all want to send to our students. So as you continue to go through this, we'll find that slides 13 through 23, but I will give you all kinds of ways to look at our loans, subsidized, unsubsidized, plus in billions of dollars, and what we've seen and the trends that we have, both undergraduate and graduate. Okay. Some additional information, as you can see, a number of borrowers. They give you a debt size. They give you averages here on the loans. Again, this is, this is a very comprehensive report. It does have a written report behind it that I think people will find quite interesting if you felt you wanted to continue to go through it. The highlights it itself give some very good overviews of where we stand today as a nation and what the trends have been in student borrowing. Okay. Percentage of undergraduate students borrowing the federal subsidized and unsubsidized loans combined, some no loans, some actually combined loans. There are some students who take both in any one year, and some families that will take later will take plus loans in addition to that as well. As you can see, students are eligible for their first level of need. For example, as a freshman, first year student can borrow money and then an additional $2,000 for an unsubsidized loan. So based on their levels. Okay, let's see. I don't know if you want to continue to go through this. I think there's one important chart I think we should look at in this. Because I think they kind of go hand in hand. And particularly if we're looking at our Connecticut schools and our Connecticut residents. And if we go to slide 29 and 30, down to 29, I think that's, okay, let's stop here. This is straight state grant funds per full-time equivalent FTE for undergraduate students for 2019-20. And I think where you'll see it starts where it's 0 for state grants per full-time equivalent. You'll see that Connecticut, unfortunately, is at the lower end of the spectrum. We are the lowest of all the New England schools and of the tri-state area schools in offering grant assistance to our students on an FTE. So obviously, when the students have less to be able to contribute towards their cost of education, there's going to be greater reliance on loans, both for access, but even more so oftentimes for our Connecticut students for choice as to where they want to attend. So I think that's important to note that as we continue to go through this, it does kind of go hand in hand, particularly for those lower income students. Okay. Okay, so is there any other questions on this? Like I said, this is a very lengthy report. As you can see, there's a number of slides here. But I think this is what I would consider to be in our space, one of the best reports to give us the most comprehensive information from federal to state to institutional grants, loans, and work programs, and also includes tax benefits that people receive.
Well, thank you, Julie. There's certainly a lot of information in there. I think it would behoove us to kind of go through that independently offline and try to absorb it. So a little homework for everyone. But I guess that, you know, the trend line, like you indicated, and the increased use of grants, I think is obviously encouraging. It's a good thing, certainly for lower income families.
Mm-hmm.
And I wonder too, just a question. I think I probably know the answer, that the full impact of our new PACT program, which is our, you know, debt-free college program, has not really
No,
absorbed into this data, right? So
no, it would not
I
be.
think that
No.
Connecticut would move up that chart on slide 29 a little bit more, which again is encouraging, but doesn't mean that there isn't obviously still a lot of need there, as I'm sure you know. You did send over another. I just want to call this out real quick. I believe it came from you, a spreadsheet showing default rates across Connecticut.
Yeah. Mm-hmm. Yes, myself and along with Jen Witness actually helped us to provide some of this information as well. So there are two things. I think the one thing you maybe want to pull up is the default rates for Connecticut institutions. I think that's the one you might want to take a look at. It's an Excel document. Dawn, do you have that one? All right, there's also a summary regarding showing default rates by sector nationally, but this is what you've got here for your institutions. You'll see the ones that are highlighted are your public colleges. Highlighted blue are our private nonprofit colleges, and no highlight is for our for-profit colleges. You've got 3 years worth of the cohort default rates. The most recent that was announced recently is the 2018. And I think you'll see that the number of individuals who defaulted across the top, and the number of borrowers compared to the number of borrowers. And this information does come from the U.S. Department of Ed. So this would be our cohort default rate. As you would see, we have some, I think as a nation overall, our default rates have dropped. They've actually declined, I believe, about 0.5%. And they've dropped significantly over the last several years. So I think from a default perspective, students are doing well. There are some institutions, of course, as you'll see nationally, the default trends typically, even for community colleges, will typically show those students who perhaps are more at risk, may have those, also have much higher default rates, as you would see, than some of the other institutions. that you would have, but that's according to the national trend. Overall, I think Connecticut sits well within the national trends. We are lower. And I think all in all, this is what we have here.
No, I think that is germane to our conversation, certainly, as you look at this list and see who's on top and who's on the bottom, perhaps predictable. We see Yale is not quite dead last. Hartford Seminary, but we see we see Yale, Wesleyan, Connecticut College, Trinity down with these tiny default rates. I think that that kind of goes to what the working group is talking about. Okay. So what I want to do next is maybe go to Bruce, if Bruce is still with us. I saw Bruce's hand popped up, and hopefully Bruce is still with us. And I know there was also some information that was provided from the credit union, so I did want to give Bruce a chance to maybe talk a little bit about some observations from the credit union space.
Sure. And I'm still driving, so forgive me for not turning my camera on or reading from my data, but I'm sure you would agree that's the more prudent course of action. But thank you, Mr. Chair. I would like to add some qualitative context, I think, to this discussion. And one is, we talk about access to credit, that's important, of course. And then this conversation moved into looking at default rates and segmenting those. That, of course, is also very important. And I think we need to be able to track delinquencies as well as best we can. But what goes along with that, with tracking delinquencies, also implicates to what extent lenders are doing pre-loan counseling. So if a borrower comes in with, an admission to expensive school A and inexpensive school B, are those people getting the right resources to be able to decide which school to attend? Because putting a person in a right-sized product, of course, also affects their ability to repay. I think if we're looking at trying to get people, educated and able to, frankly, make a profit in their own lives, we have to, help them figure out the impact of their debt load upon graduation, whether or not they can repay it. So, that would be my context. I think the data that we've seen so far is pretty great and pretty extensive. And as you mentioned, Mr. Chair, taking some time to independently digest that report, as well as the data that everybody else sent in, I think will inform greatly our next conversation. So I think I should probably stop there because I'm not prepared to share my share my document.
That's okay. Thank you. Okay. And then before I just kind of open it up to discussion here, we also got something from Winston earlier today, who I think maybe provides just some context on repayment and forgiveness options, particularly on the federal level, as I think your experience there is pretty valuable. So I did want to give you the floor, Winston, for a little bit to talk about forgiveness and sort of some things that are happening on the federal level, and I think that's particularly helpful as we segue into sort of talking about possible solutions or things that can have a positive impact here on the state level.
Yeah, certainly. Thank you, Representative. So as I'm sure many folks are aware, there's just a lot happening at the federal level with respect to federal student loan debt, as we've heard a variety of members mention already during today's meeting. Most student loan debt is federal loans. About 92% of the student loan debt out there are federal student loans originated or guaranteed by the federal government, by the Department of Education. There have been broad calls for cancellation. There's also a lot of more sort of taking a scalpel approach, improving programs that already exist for loan forgiveness and affordable payments. Public service loan forgiveness, which you see on the screen right now, is one example of that. The idea, right, is that if you work in a qualifying public service job for 10 years and make payments afterwards, the remainder of your debt, of your federal student loan debt, can be forgiven. Mostly unsuccessful program in terms of folks who should qualify getting through the program successfully. And the Department of Education just announced last month a massive overhaul, although time limited, to get folks who should have gone through the program successfully but didn't for a variety of reasons through over the next year, through October of 2022. So there's a big push, and the Student Borrower Protection Center and many other folks are pushing to make sure that borrowers and their employers and the federal government and state governments do everything they can to get everyone through that process between now and the end of October of next year. It's going to be a lot of work, potentially hundreds of thousands, if not, a million plus borrowers getting their debt forgiven. There are other loan forgiveness programs out there. There are other ways to make federal student loans more affordable on a monthly basis. And we are about halfway through a process right now called the negotiated rulemaking with the Department of Education. So just as an additional context for this group, basically during the same tenure of this group convening, there are representatives working with the Department of Education, representatives from all sorts of stakeholder groups meeting with the Department of Education every 4 weeks. Last week was their second of 3 sessions. The final will be in December, to basically talk about what program and program rules at the Department of Education level need to be revised to work better for students and schools and all the stakeholders involved. So this is a very timely conversation that we're having here in Connecticut, as there are similar conversations happening at the federal level. And I think to some extent, what happens at the federal level informs, but does not have to dictate what happens at the state level, and what Connecticut is able to provide for its residents. What you see on the screen in front of you is our organization sort of created an explainer page for folks to help navigate, including short videos to help guide them through the various steps they might have to take. One other thing I'll flag, though, that is part of this broader federal conversation, and happy to speak with anyone during the meeting or offline about these various federal moving pieces, is that although it's true that 90 to 92% of outstanding student loan debt is federal student loan debt, that 8% remaining and change is still significant. And I think we all can agree having those, even if it's a smaller portion, is still affects folks' household budgets. But it's also a growing percentage, right? So I have up here, and maybe I can share with the group afterwards, the New York Federal Reserve Bank puts out quarterly consumer credit household reports, and the November report just came out. And you can sort of see how student loan debt has been trending to be a larger portion of household credit over the past decade or so, but private student loan debt is also growing at a rate that's faster than a lot of other consumer credit portfolios, auto loan, mortgage loan, et cetera. So I think, we're having the right conversation. So I guess I'll just underscore that even though relative to the federal student loan portfolio, private student alternative student loans are a smaller portfolio, it is growing and it has a substantial effect on household income. And I think that we should just stay attuned to what's happening at the federal level to make sure that we are learning from successful outcomes there, learning from less successful outcomes there as well, in terms of what it even means to be affordable, which is sort of up for literal debate right now during their negotiated rulemaking process. So thank you. Again, if there's any threads of that folks on the committee want to talk about, happy to do that. But I just wanted to flag the federal context to the extent it informs the conversation we're having.
That's very interesting, and I think certainly timely. What we were just looking at there on the screen with the public service loan forgiveness. So, be remiss if we didn't give a shout out to your organization for doing so much good work on that. For those who saw 60 Minutes about a month or two ago, and then some of the action that took place on the federal level. After that, you all deserve some credit for that. But at the same time, as you said, looking at the private loan market, and I think we're we sort of have a little bit more of a focus on that, even though it is such a small piece. I think part of what we're talking about here in terms of student loan debt and sort of the backfilling, if you will, that takes place through private loans is of a concern to us. And I think too, as I look at the list too of Connecticut institutions, many of whom at the higher end of that default rate list, which are, trade schools or specialized schools, I think, again, where you have those high default rates, you have lower income borrowers who are looking to advance their careers, and many of those, as we in the legislature here know, are high demand fields in which we're trying to grow our workforce. So I think that all sort of weaves together, I think, to provide a picture of what we're really talking about.
Can I actually just add one more point based on, I had meant to flag and build off something that Julie had said, which I thought was really important. The resources she shared on the screen are extremely helpful. The cohort default rates, as you just mentioned as well. One thing to think about for this group, although it extends beyond the time frame of our work together, is that those cohort default rates are in large part based on federal loan defaults. And because of the CARES Act effect of suspending payments since March of 2020, we're entering a phase where those 3-year lookbacks may not actually be as representative of the student borrower outcomes upon graduation. So, but what I mean by that is someone who graduated in 2019, 2021, we are going to have artificially, how's this math going to work? Deflated cohort default rates, right? Because no one with a direct loan owned by the federal government has, as a matter of law, has been able to default since March of 2020. So those figures, it's going to be really interesting to see how the whole apparatus, many folks rely on those CDRs, right? It's much easier to say than cohort default rate. And I don't think that there has been a particular solution or substitute for the near term where we're going to have a period of inflated or deflated, I guess, rates going forward. So I think it's important to have flagged, and we should think about it, but to the extent we use those as metrics moving forward in the near term, we should be cognizant of that fact.
It's a good point. Good point. Okay. Anyone else? I just kind of open it up. I know we were moving pretty quickly there and a lot of information. Anyone else? Oh, I see Josh has a hand up.
Thank you, Jason. Yeah, I'm thinking holistically about the data presented and some of the information from Julie. And I had actually seen this in the state aid information in a CCIC newsletter back in March, and that's information that's troubling to me. This newsletter from CCIC stated that 43 other states in the U.S. spend a greater percentage of state funding for higher education on student aid than Connecticut. So while I understand this task force is focused on, access to affordable student loans, why is that state aid in Connecticut is so low compared to the nation? Like, what is causing that? And is there anything that can be done there as well?
No, that's a good point. Again, I guess my first thought on looking at that was, again, the impact of the PAC program as that comes fully online, I think might move that needle somewhat. But that's a good point and something that I think bears some further research. Jeanette?
Yeah, I just wanted to echo something that Bruce said earlier about the importance of education of students early on before they become borrowers. And I think, making them aware of what their options are and how to assess their options. And that it is something we're trying to do through this outreach program where we're going into high schools to, things as simple as, in-state versus out-of-state tuition is a factor in deciding where you want to go potentially. And then also making students aware of the tools that are out there where you can, plug in an expected salary and it will show you, how much debt you can afford. So those types of things are out there. And I think it really speaks to the need for, financial literacy education in general, but also to focus on, how to assess your needs with regard to financing your education and identifying affordable education options.
Very good. Bruce.
Yes. As we move forward in this conversation as well, and thank you, Jeanette, I appreciate you echoing that sentiment. I should have led off with that. Helping a student make the right choice at the outset clearly, can pay a real dividend at the conclusion. Exactly. Forward, we need to look for, yes.
We lost you there for a bit, I think. Can you hear us okay? Oh. I think you're breaking up, Bruce. Tell you what, we'll try to come back. Anyone else in the meantime have any other comments? Krister?
That's fine.
Thank you so much. I wanted to first say that I really appreciate everybody taking their time and sort of sharing the data. I think it's really important to have these conversations and sort of see what ways we can imagine. And I think as you all were talking, one of the things that was making me think of, right, was really looking at the experience of the students holistically, right? It isn't just an expected, how much do you think you're going to earn after? I have colleagues of mine who graduated with the exact same degree that I have. I make X number of dollars. They work at Amazon warehouses, right? So making $15 an hour, and it's exact same degree, exact same school, right? So I think those are really important considerations to have. And I also think in terms of loans versus grants versus education, I think education is extremely important, right? And I also think that some students will have to make those choices. And as we're making those choices based on family income, generational wealth, really thinking about the ways we can implement grants at the intersections, because as a low-income person, having access to a grant or a loan that is also low income, right? That would be for low income or for low interest rates, right, would be a lot more of a support system than if I had no access to extra loans, right, and not being able to finish a degree or have X number of student loan debts of years without an actual degree, which happens often, right? The amount of students who don't end up graduating with their 4-year degree, right, or with their 2-year degree, depending on what school they go to. So I think those are accounts to think of it as well. So I think really encouraging folks to think about ways to support the programs holistically, so that those are at the most need are getting some of the best benefits, or some of the benefits, because I think that sometimes in these programs, lowest income folks don't have access. And so really thinking about, a thing that I thought about earlier was looking at how much do we spend annually on loans, right, and who gets them, and how much do we get in terms of how much do we spend in scholarships awarded, right? Because really being able to see that difference and who has access to the loans, low interest loans, as well as those grants, is really important as we move forward. I just wanted to add that bit as well.
Thank you. And we have touched on that, how to measure outcomes, and I would defer to others as to how we could perhaps measure that and provide some meaningful data in that regard. Something to think about for next time. I'm going to go to Matt Smith.
Hi, everyone. So with regard to this conversation that we have about educating students and everything, I think it's important to realize that, we are asking 17-year-olds to take out thousands of dollars worth of debt. When people go and purchase a home, they're accompanied by an attorney who's been through the process and can walk them through, and they sort of know what they're getting into. Students and parents are sort of left, they're only going to do this once or twice in their life, depending on the number of kids, maybe more, but, we'll say once or twice is probably a good thing, maybe a little bit better the second time around. But I think that begs the question, maybe having, higher ed or the state Department of Education, as a part of this conversation on how we can sort of reach those students and educate, not just the students, but the families, and how we educate families on what it's going to be like taking out this kind of debt. For me, that's an important aspect. And then just on the, this is just a little thing for me. We talk a lot about how do we pay for college and everything. What we don't seem to talk a lot about is why is college so expensive? Why has it, like, the price of a college education has, gone up since I was in college, has more than doubled. And so we don't hear a lot about that conversation, probably beyond the scope of this group, I will admit that, but that is something that I tend to think about a lot. Is we talk about how do we pay for this continuing increasing cost of college, but never like, how do we control that cost? What is it that's driving that cost? So that's
Absolutely. A very,
2 cents.
very big question. And yes, I think a little beyond the scope of the 2 meetings we have left. But to your first point, and we've heard it from several members today, and the point is well taken on financial literacy and education. I think that is something that we could certainly make an impact on. And, speaking for folks on the banking committee, that is a conversation that comes up every year, and I think is one of the priorities for the banking committee this upcoming legislative session, because of the backlog of legislation and things that were happening last year. I think we're going to be revisiting those issues again. And it involves a broader discussion with educators as well, to talk about what we're doing in our schools. But yes, the point is well taken, and I'm hearing the refrain from this working group. So I think that is certainly something that we want to emphasize as part of this discussion. I'm going to go to Winston. Winston.
Thank you. I want to make sort of two points, or maybe one large related point, but starting off with this point of education. So I wholeheartedly agree we should be making sure everyone is making informed decisions when they enter into these financial contracts and make decisions that are as major a life sort of milestone as attending school, which some folks do once, some folks do multiple times. But I also think, as someone once said to me, we need to understand the full context in which people navigate the school system. Is that when you're 17, why your expected earnings may be what you expected, may be lower, maybe higher. And that's that I think this is within the scope of this committee. We are living in a world where different people get different outcomes, even if they're otherwise similarly situated. And you can't educate your own way out of societal bias, right? So we can educate people about making their personal decision, but that doesn't mean that they can educate their way over the gender income gap, the racial wealth gap, right? So I think those are factors that really matter. And we know, for instance, that Black women hold a disproportionate amount of education debt. That's in part because they are high attaining, degree holders, but that's also because they have to borrow more to get those degrees, right? So it's not just about personal accomplishment, although I think that sometimes gets written out of that stat in terms of why people have debt. But so I think the education, the reason why I want to flag this is because it's worthwhile. It should be thought through holistically in terms about where's the water's edge on educating folks about entering these contracts, and where throughout their life might they come across hurdles that can be addressed in that upfront education. But also, we are in a government committee right now, right? And government has extraordinary powers, but limited resources. So in terms of figuring out where the most bang for the buck can be from this process, I think it's important to balance the educational opportunities from the potential structural changes that might not put the onus on the individual to educate themselves out of difficult situations. But again, I want to sort of underscore, education is very good. I'm a consumer attorney. That's my background. I think we should make sure people enter situations fully informed, but there are things outside of individuals' control. So I want to make sure education's on the table, but doesn't sort of take up the whole table. I think that was it. Oh, and also in thinking through the fact that we're in a pandemic still, right? And sort of hearkening back to the federal government analog. I think thinking about the fact that some do, but not all private student loans have the same safety nets that the federal student lending system has. And that makes sense. I understand why that is the case, right? different incentives, different requirements, different bottom lines. But I think now more than ever, we can understand that sometimes life comes at you, and for no reason, for nothing that you did yourself, you find yourself in a situation that couldn't be underwritten when you were applying for a loan, and has nothing to do with your credit score, et cetera. And if there are ways where we can find opportunities, and Connecticut has just done this, we passed laws here that have started to build in these processes, but thinking through extraordinary life event safety nets in the private lending system is, I think, something that we as a country should all be doing going forward.
Good points. Thank you. We're going to go back to Bruce, who hopefully is in a better area right now. Bruce.
I hope I am. Shut me down if you can't hear me.
Sounds good.
Okay. So I've got a lot to say on the education front, which I will pass over for another time. But I think we do need, apropos of this discussion, to look at the quality of servicing. Avail themselves of options when life comes at them. And what is their experience during performance of a loan? And I will leave it at that, at the risk of going into a worse sell zone.
Okay. You were breaking up a little bit there, but I think we got the gist of it. Hopefully next time I'm personally inviting you, and of course everyone, to the LOB here for our next meeting, which I think has gone pretty smoothly, generally speaking. Okay, anybody else right now? And I think we'll start to wrap up. If not, again, I think we heard a lot of good information and have just started scratching the surface here. So I suppose for the next meeting, we did have some suggestions on ways that we might be able to drill down or other data points, particularly on the Chesla numbers. I heard the overall approval rates by town, if we have that information. I'm trying to see, there was some discussion about reasons for denial. There was some discussion about trying to measure outcomes. Anything else that I've missed that other folks would be interested to see for next time? And Jeanette and team, I guess I'll throw it back over to you as well for any other comments on that and anything generally to wrap up.
Yeah, I think any other state specific or, lender specific data for Connecticut that can be provided, would be helpful.
Okay. And then finally, I guess I'll start to ask folks to start thinking a bit about potential solutions. One thing I know that we will do on our end is to try to look at some other state programs, perhaps, because of course that is sort of the charge of this working group, is to identify potential solutions on a state level. And we will try to pull some resources together and send them out to everyone to start to identify some things that might make an impact and things that have been successful in other states. So I would just ask folks to start also thinking along those lines, and we'll try to again send out reminders on email. A reminder again that we do have a Google folder, which we are working on our end, trying to sort of sort that information out. And so I would ask everyone to of course take a look at that. Think again about if there's anything that you'd like to submit or contribute to that. and to keep the discussion going in the meantime. And then, for our next meeting, to follow up on the discussion we had this time, any additional data that we think might be useful. And then, like I said, start to maybe pivot to talk about some potential solutions to this issue. So with that, if there's nothing else, we will adjourn, I think, until our next scheduled meeting, which is the second Tuesday of December, which is December 7th at 2 p.m. And again, would invite all those who are local to attend if they'd like here. Otherwise, we'll do this again. I think, again, it worked pretty good. So with that, we'll sign off and see everyone next time. Thank you.